there's any opportunities to get into some stocks. To evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable.
Hey everybody, welcome. It is Friday.
You look at the best companies on the stock market.
It is Friday after the market closed, and the stock market was a little kinder to us today. It closed at a nice high, and that was good news because yesterday it sold off quite dramatically. As you guys likely know, it was a tough day. It's a tough day in the stock market yesterday, but today the market really rose nicely. Came back, the NASDAQ was up 0.80%. S&P up 0.41%. The Dow up 0.69%. So it was a good bounce back day. The Russell was up 0.61%. Very good. A couple notable names. Intel really rose nicely. So did Amazon. So did Chevron. And a couple of other companies. So it was a good day of bounce back of stocks. So, all right, stock market. It didn't go into a tailspin. And as we approach the election, it surprised me, frankly, that the election hasn't really become this big, tension, fear, anxiety-driven, kind of event. We have 1 day of trading before the election happens, and then Tuesday we have the election. So I think Tuesday will probably be muted. The market's probably going to be low volume, but we'll see. And I made it through October, okay. I lost a little bit of money. I was running flat and then up, and then yesterday kind of tanked my gains. But overall, year to date, man, I'm doing great. So I'm trying to make money over time. I'm a long-term investor. I like having a game plan that I make money every year. And so 2024 is going to go in the books as a positive year. And we'll head into 2025 to figure out how to make good money out of a long-term investing portfolio. It's good to see Omar on the call. Thanks for joining. Mike, good to see you. I'm sorry I couldn't stream this morning. I attended a really nice Halloween party, and man, it was so awesome. And I had a great time, but I got home super late and just could not make it to the stream this morning. So I apologize for that. But here I am talking about the stocks that did announce. So Mike, you wanted to jump in. Yeah, the last 2 weeks certainly have been painful in some areas. And I know yesterday it was not fun to be a Robinhood stockholder. It was not fun to be an Uber stockholder because those two really went down a lot. And Meta went down. So, man, my portfolio really, really got hit. Again, long term, I'm doing great. So a couple bad days, that's all right. We're having a historic, very good 2-year run that started back in 2022. And I'm not going to cry over one bad day because we're up 74% on the NASDAQ. So let's just keep investing in great companies that are going to go up in value year after year, continue to appreciate year after year, pay us dividends, and reward us as investors in these great businesses. So, Shadow Guy, good to see your name. And let's see here. Did you go as a super investor to Halloween? No. They didn't have costumes for such a thing. And I don't think most of the people at that party would know what that is. I went as a different outfit and had a great time. And Bad Omen, good to see you, man. All right, guys. So I had some stocks in mind on that announced today, and I wanted to get things rolling with Exxon. And Exxon was down a little bit today, 1.57. even though they did make, substantial amount of profit and a lot of cash flow, and I'll get into that in a minute. Exxon for the past year has done 8.6%. And when you add on that dividend, you're up to about 10%. With the market doing what it's doing, that did not keep up with the NASDAQ nor the S&P, but it is oil, and oil is, I think, discounted right now, or I should say the per barrel price for oil is down. And that's what's keeping down Exxon. It has been kind of a surprise. Now, when you look at, they hit a peak in April and have pretty much gone sideways since then. So Exxon's a quality company. They own the rights to extract oil from different parts of the world, a lot of them in the US, some of them internationally. And it's a really desirable business. Here's my desirability quadrant, and I put all the companies I'm going to evaluate. And Exxon is definitely has a lot of barriers of entry in the form that they're allowed to extract oil in the places where they have the rights to the minerals, and they are doing so. So they are part of an oligopoly, which is of these major oil companies. Some people resent them, and they have a right to, and I have a right to invest in them because I think oil is a necessity, and I'd like to invest in some of these companies. So Exxon did, I thought, quite well. I thought their earnings were good. Sluggish profits were driven because of oil prices. And when I look at a company and they operate effectively, but it's not their fault that oil prices are lower. So I don't really hold that completely against them. I imagine at some point oil is going to rally. And heck, we could see oil above $100. And when that happens, you'll see that Exxon and all the other oil companies will really fly up in stock price. But this one here is selling at 14 PE, forward PE 14. That's pretty darn good. Analysts think it's discounted by 13.68%. When we look at their financials, this is a big, big company with trailing 12-month revenue of $344 billion. That's up there with Microsoft, Apple in size of revenue. Now, it shows that trailing 12 months, their revenues have been going down. But if you look at the quarterly, they're actually flat in the quarter they just reported, which I think is a win. Considering that the oil prices had gone down, that's a pretty good number. So good job, Exxon, for growing a tiny bit. What's impressive about Exxon is their cash flows. And that's why I invest in oil companies is you see their cash flows, and I'm looking at the quarterly. So I want to change that to the annual cash flows and trailing 12 months, $32.7 billion of cash. Wow. It's a lot of cash. In 22, when oil prices were substantially higher, they generated $58 billion of cash. That's really good. So a company like this, you can get to the valuation. It's not that difficult to prove value for an oil company. I would say that I'm going to be a little more careful in not owning too much oil companies, because when you have these periods when it's oil prices are down, the oil companies have a hard time. And it's really not been a complete loser in my portfolio, my investment in Chevron, but it's really lagged the other investments. So Exxon had a good earnings. I think it's a solid investment, really good dividend at 3.31%. And oil, I view that I always want to have oil in my portfolio because it's a necessity in the overall global economy. It's not going to go away very quickly. I know that there's aspirations where we're going to have electricity, power cars, and all kinds of different things. So I'm going to have it as part of my portfolio going forward for the foreseeable future. Now, the two companies that are the biggest in the oil business is Exxon, and then there's Chevron. And Chevron did have a good day of 2.86%. I think they did better than the market expected. So the market really reacted. And part of why the stock really rose was for the year. And you can see that this includes today's rally. the stock was really lagging Exxon. It wasn't doing all that well. So today was a day when it kind of made up for some of that, you know, sluggishness in the stock price. So it's good to see that today. But overall, 5% for the year plus a 4% dividend. That's still not a great return. It's still in the positive, but it's not a great return. It's a big company, big market cap of 279 billion, big revenue 191 billion. And it is, I could prove discounts on Chevron. In fact, I'll show you my valuation in a moment. But this stock here, the company is very well run. Chevron is very well run, and they're getting bigger. They're going to acquire another oil company, Hess. And when they acquire Hess, they're going to become bigger and have more advantages. One of the things about Chevron and Exxon is they're referred to as a fully integrated energy company because they go find the oil, they drill in either on land or in the middle of the ocean. They would drill, extract the oil, pipe the oil to a refinery, refine the product, and then sell the product. Sell the product as gasoline, diesel, lubricants, and so forth. So they cover that whole process from finding it to when you buy it at the gasoline station and put it in your gasoline tank to use in an automobile. So that integration allows them to make money. If oil prices are down, well, their retail side will then still be profitable because the input of the retail of making gasoline is less expensive, and they still get to make a margin when they sell it to the customer. So it gives them an advantage and more stability. That's one of the things that I like about Chevron. So Chevron is a good company. I'm looking at their income statement. Let's take a look at their quarterly growth. They did lose a little bit of revenue in the most recent quarter. It's been kind of a red, many quarters are red. And it's that oil price. That's where the problem lies. And they can't directly control it. They have to wait for oil prices to do better. And then the company will have greater revenues and greater profits. Now, on Chevron, their free cash flows are excellent. Their market cap is lower than Exxon, but so are their free cash flows. Cash flows of $19.77 billion. Very good. I have a fair amount of Chevron, and I think overall, when you look at their fundamentals, you just see very high discounts because just over time, the oil price average over time is just going to allow them to accumulate a lot of cash on the balance sheet, buy back shares, pay dividends, and that in itself is going to be valuable. Their cash flows are just really good year over year, very good cash flows. So when you value the company that way, it really produces a nice discount. Earnings per share also produce a really nice discount. And so right now, yeah, I think Chevron is discounted and is a good idea. But for me, when I look at Chevron, I'm already a pretty big stockholder of the company, $100,000 investment. So I'm just going to stay put. I had thought about selling some shares and bringing down my position, but at this point, I think I'm just going to wait until 2025. Part of it is that I'm sitting on realized gains already. If I sell Chevron, I just make that pile of realized gains even larger, and I get to pay more taxes. Yay. And no problem paying taxes, but why don't I just wait 2 months? And if I still feel the same way, I'll lower my position by 20,000, and then I'll get a lot of time to pay those taxes. So that's my position on Chevron. I think it's a terrific company. I want to have an energy company in my portfolio going forward. And they're both really, really good companies. These are just obviously, they're obvious good companies, Chevron and Exxon. In the stock market, we could look at, some smaller stocks where the future's not very clear, and you can take a chance on them. Like Robinhood as an example. That stock's gone up and down, and the future is not completely clear. Now, with the higher risk, you get higher reward. Robinhood's been doing great for the last year. But with a company like Exxon or Chevron, the future is pretty clear. These guys are going to keep making that kind of revenue and profit and so forth. So they become pretty valuable and stay there. So it is good to have in my portfolio stocks that are a little bit of an obvious good place to put money in. And I will take my chances on smaller stocks, riskier stocks, and really work to have those pay off, like the Robinhoods, United Therapeutics, Catalyst Pharmaceutical, symbol U, which is a security software company. So those stocks I think are going to do quite well, but I also know that small stocks tend to surprise us. And when they surprise us, they really go down fast. So that is Exxon and Chevron, two really good companies that announced today and are good companies to consider. Looks like Neil Weston is in. How you doing, man? Good to see you. Shadow guy. So you switched from CBX to Exxon. Yeah, I think either one is good. And for a long time, Exxon has outperformed Chevron. I've observed that. Exxon's a quality company. They're the biggest, and I think a solid position. All right. So then Neil. Yeah, cool deal. So we went over the big oil companies, and I wanted to kind of take a nice sampling. There's so many earnings, right? I can stream for the next 4 hours and still not cover every company. So I selected a few stocks out there. Looks like Irwin joined and Drone Boy. So you own both Exxon and Chevron. All right, cool. I guess I'm going to call you an oil man. And all right, so Simon Property Group is a real estate investment trust. And I'm trying to figure out really quickly. So they develop premier shopping, dining, entertainment, and mixed-use destinations. Okay. And judging from how, retail is doing, which is retail is hit and miss. And I know that some retailers are having a lot of trouble with theft and it's just expensive to run. But it could be worse. You could be in commercial properties that are office space, and that's really taken a big hit. Over the past year, this company has done quite well, up 52%. Over the last 5 years, it's only up 11%. And it's really a story of buying this stock at the right time. If you buy at the right times, you're going to do well. So you got to do your homework and then buy at the right times. I like to dollar cost average, and some of my good friends on Discord like to lump sum invest. I think either way will get you to that outcome you're looking for. But it is always wise to try to do your homework and buy when the stock is discounted. So that way you could appreciate or participate in the appreciation runs of these companies. In this case here, this has been a winner for the last year. They're up 52% and they pay almost 5% dividend. Wow, that's great. So market cap's 54.68%, $54.68 billion. Revenue is $5.91 billion, and PE ratio of 22 for the current year. And the next year, it's going to go up to 26. So this company is fairly priced, maybe priced a little bit at a premium. Now with a REIT, we want to look at funds from operations as well as their earnings per share to see how well they're doing. Funds from operations is where they're going to draw that dividend. And we want to make sure they can afford the dividend because that's why REITs are a good investment. REITs are not the type of investment where you expect every 5 years it's going to double in value. Now, if it does, that's great. but it's really not expected. It's expected it's going to give you good income and overall give you a very good rate of return, which is a combination of a solid dividend plus some appreciation over time. It's not like a, let's say an Uber that's going to double in value, triple in value. It's more of a steady stock. And this one here did really well for the past year. Let's take a look at their financials. Looks like their rental revenue went up. So total revenues did expand quite nicely. Very good sign that their properties are desirable. Their leases are going up in price. Those things are good. Very good. When we look at other metrics, earnings per share of $3.52. And then funds from operations, 4.6 billion. Funds from operations per share, 12.51. So $12.51 of funds from operations. And their dividend is $8.20. So they can very easily pay their dividend. Their dividend is really safe. So you could value the company by discounting the dividends that you expect with the net present value you're comfortable with, and then value Simon Properties. When we look at their earnings per share, their earnings per share is for 2025, and I like to work at this point, right? We're already in the month of November. I'm already looking at 2025 because most of 2024 is in the books. It's in the rearview mirror. So looking forward, 6.57. Analysts think that there is going to be a drop in revenue, and that's going to make it a PE of 25. Looking at that, the analysts believe that it is priced a little bit expensively. So I think I'm going to take their word for it. I think REITs have done really well for the past year, but might be a little bit expensive to come in. I'd probably wait for this stock to drop some. It has shown in the past that it will drop, and then you can buy it at a nice discount and then be sitting on a nice gain or close to even. And then you're getting that really nice dividend. That's what I've tried to do with REITs. I don't buy too many REITs. I own one, and that's it. And this one here, it looks like the market sold it off a little bit on a positive day. It's important to note that sometimes the market will sell off a stock just because the whole market's selling off. In this case here, the market was quite positive and it sold off Simon Property. So it might have a little bit of a sell-off next week is my expectation, given that investors did not like what they saw completely and sold the stock off to some extent. Now, the stock that really, really took off, and before I move on, I think Mike had a comment on SPG. So let's take a look at that comment before I move off of Simon Property. So SPG has too low of dividend growth for me. I don't see malls as a good investment long term. I have to agree with you on the viability of the mall long term. I think malls conceptually, right? That's like a 40-year-old concept. It's longer than that. It's just the current mall kind of footprint where you have a lot of stores coming together and so forth. It's almost like they really designed that before we had, Amazon and e-commerce. Now you have access to information on any product that you want. You don't have to go to the mall to shop around for shoes and stuff. You can go online and check it out. Nothing replaces looking at the product firsthand. So I would acknowledge that. But man, when I go to the mall, there's a lot of businesses that are bankrupt. I know that Macy's has had a lot of trouble. JCPenney bankruptcy. So a lot of the tenants have had trouble. So I can't argue with you that, hey, malls over the long haul, I think that whole business is going to have to get redefined because e-commerce continues to disrupt that space over and over again. I'd rather invest in Amazon than in malls, and I am an Amazon investor. So I agree with you, Mike, and we'll see how things play out for SPG. Yeah, and I also like malls, by the way, because in California, sometimes in the summer it gets super hot, and I like going for walks with my wife at the mall, have some dinner, shop around a little bit, and that's a pleasant experience. All right, so we're gonna move on to Charter, which was a real big winner today. Holy smokes, up almost 12%. Good job, Charter. So Charter is classically a cable company, but they did the smart thing and they started diversifying into broadband. And that's where the money's at for the company now because, cable is just getting disrupted by the streamers. And Charter, let's take a look at the revenue. The revenue's been growing. Good job, Charter. You would think that if they have cable operations, then they're just getting replaced left and right, but they've been able to preserve the revenue. So I really commend their management team. Now, one of the things that I've always run into with companies like this is a $52 billion company, revenue of 54 billion, net income, and the PE is really low, and forward PE is really low. They don't pay a dividend. When I look at AT&T, Verizon, and even T-Mobile, I don't like their balance sheets. They carry too much debt, a lot of debt. So let's take a look at Charter's balance sheet and see what kind of debt they're carrying, because that's always a trouble spot for me. So they have EBITDA of $21.42 billion. They have debt of $95 billion. Holy smokes. 95. So they're going to be about 4.5 debt to EBITDA. I like it to be below 3. Now, as interest rates drop, this high debt level is less of a liability because you're paying less interest, especially if they can refresh their debt and reissue debt to replace higher interest debt. But man, when interest rates really went up, you really saw AT&T and Verizon, in this case here, this company, their prices really went, or their stock prices really suffered because investors were smart and they're like, hey, you're going to be paying a lot of interest. In fact, when we look at their income statement, let's take a look at where their interest expense is. So here's their interest expense. $5.2 billion of interest being paid. That's a lot of money. So that's almost 10% of their overall revenue is paid in interest. That's really, really high. That's why I don't invest in these companies. The balance sheet just really scares me. They're always going to be burdened by it. It's almost going to be an anchor. Over 5 years, it's down 21%. Over the 1 year, it's down 9%. Year to date, minus 5%. So I'm glad they had a good year, a good day. But these are just companies that I stay away from. These guys are in the same category, communication services, I believe. Yep. As Google, Alphabet, Meta, Netflix, Disney. Comcast was the one company that Comcast does have a broadband business, and their balance sheet's far better than this. And I think it's because they have a more diversified business where they actually produce movies, they make movies. They also have theme parks, things like that. So when you look at their debt, it's not as high compared to their EBITDA as these pure play communications companies like Charter, Verizon, and AT&T. So I'm glad they had a good day, but it's just not a company I can invest in. The balance sheet's just terrible. And I just think that these businesses are just getting dragged along. The market really tells them what's going to happen. The competition for broadband is really high. I pay roughly about $60 for broadband, and I get fiber. It's really fast, which is great. And I used to pay $200 to a cable company to get their fastest speed, which was like 20% the speed that I have now. So Now I'm paying much less. I'm paying 30% of what I used to pay, and the speed's 5 times faster because these companies compete against one another to try to replace each other in households and businesses. So that's the reality for their business. It's not a desirable space for me, and I'm going to stay away from it. Now, I had put these guys in the gray, but this is a company I would put in the red because their balance sheets. Balance sheets are terrible. They're just being dragged along. They don't see, like, these guys have power, meaning, consumers, businesses, countries need oil. Armies need oil. Everybody needs oil. These guys have no power. They're just, consumers and businesses are going to the least expensive provider of broadband, and they can skip around as often as they can save money. So I put them in the red, and then we'll go over these companies. We looked at Simon Properties, and I put them in the gray. This one might be a little bit in the red since they are mall properties. We talked about the undesirable aspects of that. But I try to stay away from companies in the red. I know that it's sometimes you get lured into a stock that, hey man, if it bounces back, I can make a quick buck. And maybe you can. I know that some stocks really bounce off of a bottom, and that sure is a way of making a few bucks. But I'm trying to make a lot of money over a long period of time, and I think I'll do better when I buy quality companies that will continue to increase in value. It's almost like in real estate, you want to buy location. You buy the best properties, and they always appreciate better than properties that are in bad locations. So just buy good companies and stick to them. All right, so that was Charter. That caught my attention because they went up so much. I wanted to cover it. Now let's talk about Cardinal, which had a very nice day. And Cardinal Health is more of a healthcare distribution company. They distribute a lot of products. So when a hospital needs a variety of products, they usually like to have Cardinal Health as a supplier because they could order a variety of goods, stuff for their surgery rooms, stuff for their urgent cares, and just a variety of stuff, and that makes it easier on them. So Cardinal kind of has that type of business. They're not the biggest market cap you've ever seen. The reason this market cap's nowhere near like an Eli Lilly is that Cardinal Health doesn't own any patents to keep competitors away. They're competing with a variety of distributors, even the direct makers of the product. Like 3M produces a lot of the products that go into hospitals, where hospital can buy direct from 3M, or they can buy the same product from Cardinal Health. And Cardinal Health would be competing on price and squeeze their margins. So that's why market caps are not very high, even though their revenue is really high, $224 billion. Oof, it's a lot of revenue. You're paying, the market cap is like 1/9 of the market cap. The market cap is 1/9 of the revenue, which is really strange. PE is 22, forward PE is 14.79, and the dividend is 1.74. I'm curious to see where this stock's been historically. Look at that. It's done great. 134%. Go Cardinal Health. It's really gone up and to the right, especially over the past couple of years. This past year, it really offered up a nice acquisition price. Overall, it's up 27%. But if I think you could have bought at right around the same level it was at a year ago and did about 27% from July to this point. So that would have been about a 4-month timeline. So that would have been a nice return. And you would have been paid a small dividend. So the market did like what they announced, and it's up 7%. Looking at their revenue, really consistent growth. Nice. Very nice growth. And again, the reason that they're not super valuable is look at all this revenue, but very little profit. That's why they're not really, really valuable, is they don't get to keep a lot of that money that they sold. They just keep a little bit of it in the form of profit. see what they do from a cash flow perspective. And free cash flow is a decent amount. If you look at $1 billion for free cash flow, they have been growing nicely. It's in a space that's pretty consistent, which is healthcare. I'd be willing to go up to maybe 20 since they're growing. And that value them at around $20 billion, depending on debt. Right now, they're valued a little over that at 28 billion. So these guys are priced at I think at a premium. It's not a company that I'm excited about because they don't have a lot of barriers of entry. They don't have, for all we know, hospitals begin to buy on Amazon and just skip buying from Cardinal Health. That is a possibility. Or it's maybe another company that, resembles an Amazon and provides just a better proposition to hospitals, better prices and so forth, gets introduced and really starts taking revenue away from Cardinal Health. So I think it's priced at a premium, and I didn't even look at their debt, which might be good, might be okay. But let's take a quick look. So their EBITDA is $2.92 billion, and their debt is 5.16. So the debt isn't a big problem. They can pay debt in less than 2 years. So that's not a problem. Balance sheet is fine. I just think the price of the stock is too high. It should be at around $20, $20 billion in market cap in order for it to be fairly priced. In this case here, it's priced a little too high, but investors have enjoyed a good return from this stock. So congratulations if you've been a Cardinal Health stockholder. All right, so that's Cardinal Health. And looking at a stock that was nominated, we've looked at this stock before. This is BWLP, and it's got a small market cap of 1.69. Over the past year, the stock's down 11%. Over the last 5 years, it's up 177. Wow, that's a real winner. And they're paying this humongous dividend. What does this company do? So this company engages in ship owning, chartering ships that transport liquefied petroleum gas to oil companies. Okay. So these ships are specially made to transport these very flammable liquids where they need to get to be refined and then distributed to, places where that energy is going to be consumed. And it looks interesting. I am a bit surprised that it's gone up this much, 177% over 5 years. These types of stocks tend to be less appreciating, and then they pay that dividend based on how well they've been performing. Now, looking at their revenues, what's also surprising is how fast they've been growing. I guess they're probably buying more vessels and putting them into service, is my guess. I haven't had time to really look into them. They're a small cap. And it seems like shipping companies are being brought up on live streams quite often because the dividends look good, the growth looks good, the profits look good. There's a lot of good things that look good about shipping companies. And this one, again, looks pretty darn good. The growth is good. And if I look at free cash flow, they've been cash flowing quite nicely. And they're growing that cash flow. So that looks good. We looked at this stock before, I think last week, and it looked good then, looks good now. And dividend per share is 3.28, and free cash flow per share is $4.95. So they can afford it. They've been growing their dividend. So when will there be a downturn in this space? I don't know. You'd have to study that and be aware of, what's going to cause, shipping rates to go down for these types of companies, and be aware of that. But I think investors that have invested in this stock have done really well, especially if you're a long-term investor where you bought, you're sitting on a really nice gain. And man, if you're just making this dividend and holding your appreciation even, you're doing quite well because you're making 26%. Whew. So that looks really good. Hey, Brad, good to see you. It looks like you have a bit of news that I'm going to cover in a minute. So this one here, do your homework. The shipping companies have been looking good. I've been trying to narrow in on which shipping company I'm going to probably invest in. And I've been a little slow to pull the trigger, mainly because the stock market's expensive and I want to keep my cash, because if we have a really nice sell-off, maybe you see the market like the NASDAQ sell off 20% or so on price. I'd like to have a good cash pile, which I have a nice cash pile right now. I'm mostly invested. I probably have like 11, 12% cash. And at times I've been down to 3% cash. So most of the time I'm mostly invested, but right now I have a little extra cash. And I'm not eager to buy too fast because the market's just been doing great. And it can continue to do great. I have nothing against it. I'm just thinking, when are we going to have another correction like this one? This one was a doozy. The NASDAQ alone dropped 35%. Well, I'd like to have some cash in case we experience something like this again. Then I can buy a lot of these companies that I love at a 35% discount. That's why I want to keep that cash around. So that's why I'm a little bit slow to pull the trigger on these shipping companies. They look interesting. I would just encourage you to do your homework and be cautious as you make your decisions on your investments. So good luck with that. All right, so that was a request. Let me go over Brad's breaking news. NVIDIA is going to replace Intel in the Dow. That's good. Intel does not belong in the Dow. Intel is a dumpster fire. So NVIDIA is going to be in the Dow. So I guess NVIDIA is going to see a bump in its stock price because a lot of the ETFs and so forth that have to own NVIDIA will own it. And it's a little bit of bad news for Intel because there'll be less demand for the Intel stock. So very interesting. I think it's a good move. I think it makes sense. I'm not picking sides on, hey, I like NVIDIA more than Intel. It just makes sense. If you're going to own the Dow is made up of 30 companies. Those 30 companies tend to be really good historically, very reliable historically. And if they can't keep up with that, expectation, then they should be replaced. So thanks for bringing that up. Man, I like the live stream because I get a lot of good ideas that send me off and look at really interesting companies. And these are ideas maybe that I would not have thought of on my own. You guys bring them up. And second, you guys bring good information that, maybe I wasn't paying attention and boom, hey, did you know this happened? And here I am. I did not know NVIDIA was going to replace Intel in the Dow. So I appreciate that. Hey, Mike, you got to run. Hopefully I see you over the weekend on the workshop tomorrow. We'll take on some topics. If you have a topic tomorrow, bring it. And then we'll be on the investor call on Sunday. And we'll go over some stocks and go over it tomorrow. So Yuda. Intel, I get your point, and I'm a fan of Intel because they're just historically, we're such an important technology company. But business is business. And I really got stung by Intel this year. I lost some money on Intel. And I'm not going to be bitter about it, but I'm just going to say, business is business, and Intel did not take care of business. They are a dumpster fire, and they really got to clean up the business. It was a great company. We'll see if they come back. Hopefully they're a turnaround story like 3M or GE. Those are really good turnaround stories. Brad, so SHW is also going into the Dow. What is SHW? Sherwin-Williams. Of course, man. These guys, I think, have been doing well. Who would ever thought that paint is going to be a really, really good materials company? Woohoo. That's a good looking chart there. And over the 5 years, getting it done. They pay a dividend, a small one. And I have noticed Sherwin-Williams, it's been getting it done. I just, it's a little bit of a surprise that a company that really focuses on paint, and I believe they have retail stores where they supply especially professional painters that paint houses and buildings and offices and so forth, that they supply that contractor with paint. But here it is. I'm curious to see how profitable a company like this is. They announced on the 22nd. So in normal trading was down a little bit, and then after hours on a Friday, so I don't know if it's going to hold it, they're up 4%. Is there some news? Oh, because they're going into the Dow. Yeah. I wonder if NVIDIA is also up because it's going into the Dow. And it is. It's up 3%. So NVIDIA is having a good day. Go NVIDIA. $3.32 trillion. Ooh. Man, incredible. So, yeah, so that's news. More demand for their stock. It's got a nice bump. I'm curious to see a couple things. One is their growth. It has been growing nicely. Now, when we got hit with COVID, right, a lot of people started spending more time at home, so they made their homes nicer. Speaking for myself, we did do that. We bought new appliances and stuff. We didn't hire any painters, but we replaced our air conditioning, and we spend a lot of time at home, so we upgraded our home. And I think people probably were painting their homes, making them look nicer, painting the interior, maybe trying a new color. And you could see the rise in revenue. Now, revenue has not been increasing more recently. And let's take a peek at the quarterly. Well, they had one bad quarter, but everything else is flat. Okay. Now let's look at their profitability. So gross profit's $11 billion on a $23 billion revenue. So that's less than 50%. That's probably around 45 to 48% gross profit. Not too bad. It's a material company, right? This is paint. It's been around for a long time, but it's pretty good profit for a very established, well-known company, well-known product. So looks good. Well run. If a company continues to grow nicely like that, to me, it's an impression that they're well run. All right. So how much cash do you get out of a business like this? So free cash flow, $2 billion. I think that's a good number. They don't have a nice upward sloping cash flow, but I think $2 billion would be a good number. They have very little growth, so I would value the company, $2 billion times 15, probably get to like 30 billion. I'm way off. I'm either way off or this is way too expensive. Right now, the market's telling me I'm way off, but they don't produce a lot of cash. I got to stick to my lane, picking companies that produce cash. This one doesn't, so it's not an investment for me. Congratulations to everybody that owns them because it's been a good stock. Sherwin-Williams going into the Dow. The other thing too that I think about is, now I'm probably like a lot of consumers in the US. When I need stuff for my house, I go to Home Depot and I buy my paint at Home Depot. I think back to when we did paint our home. I got the paint at Home Depot. So I think I got Behr paint, which is sold at Home Depot. So Sherwin-Williams, I think they probably service the professional contractor a little better than Home Depot, or maybe they compete against Home Depot. I would just, if you're competing against Home Depot is really strong, powerful, just great brand, really make it easier for the home improvement, either by the homeowner or even the contractor, to go to one place and then buy everything they need to do that job. Whether they are remodeling a kitchen, they're painting the exterior of a house or something, you can get it at Home Depot. So that's a pretty tough competitor. And there's also Lowe's. So yeah, I wouldn't be an investor of Sherwin-Williams. But again, some investors did quite well with it. So congratulations to all those investors. All right. So we had a really big week. If you consider all the earnings that were announced, today was kind of a slow day compared to the other days that we've seen, because we had gigantic earnings yesterday with Apple and Amazon, Alphabet, Visa the day before, Novartis announced, AMD announced. So we had some huge announcements. And where was Meta? I think Meta was after the hours on Wednesday. Yeah. Microsoft and Meta on Wednesday. Huge earnings. Next week, they just keep on coming. Palantir is going to be announcing on Monday. I think Palantir is overly priced, and we'll see if I'm right or wrong. Time will tell if I'm right or wrong. But Palantir is going to announce on Monday. And when I look at Palantir growth, it's like they're growing like Microsoft. What's so special about that? Except that Microsoft is like 100 times bigger. Palantir is one trick pony, but we'll see. We'll see. Maybe the market will teach me a lesson, but maybe I'll be right. We got Vertex Pharma, Zoetics, which I believe, does products for pets, I believe. Constellation Energy. This one's been kind of red hot. Marriott. That'll be interesting. As we leave the massive caps, you start seeing some middle of the road, medium, moderate valuation stocks. So these will be interesting to go forward with. Coupang, which came up recently. Marathon Petroleum, which came up over the last couple of months. So we'll see how those do. And on Wednesday, Novo Nordisk. This is a big, and I think this is the other company that does the weight loss drug. These guys have been getting it done. $492 billion. Toyota, Qualcomm. I'm a stockholder in Qualcomm. ARM Holdings. These guys are in a dispute. We'll see who wins the arm wrestling contest there. And Gilead Sciences. This is a biotech company. Mercado Libre. We'll see how they're doing. CVS. So there'll be some really interesting earnings next week. The names will not be as big, but they'll be really interesting. Now, a name that I'm really going to follow is Airbnb next week. That's a stock that I've put a sizable investment in, and we'll be looking at that quite closely. Fortinet, which is security software, have they taken a lot of market share away from CrowdStrike? That'll be interesting to take a look at. Arista Networks, they've been doing quite well. Arista's really gone up in value. And then Berkshire Hathaway. Oh, man, they fell below $1 trillion. What happened, Berkshire? But they're still worth $974 billion. That's awesome. And then we've got Sony out of Japan, Baxter Healthcare. So that'll be interesting to take a look at. So I'll continue to live stream next week. See how many days I can live stream. It's always dictated by how busy my business day gets, and I'll try to stream as often as I can. And appreciate you guys all joining. and participating in the live stream. And hope you guys made money this week. Overall, I wanted to invite, I know I've got several people that are paid members of the community. I appreciate your sponsorship, and I'd like to grow it. I'd like more investors to be in this paid program so we can do more, I think, collaboration. We've got a session tomorrow on a workshop. We've got a session going on Sunday, which will be an investor call. And as the community grows, I'm going to do more things. But for now, those are the two events we're going to have. And as many of you have seen, I really respond to paid members because they really showed that they want to support the community, both in one-on-one communication, as well as on live streams, as well as obviously the two events that are just for paid members. If you can consider being a paid member, that'd be great. And the information on the 3 different programs is in the detail of the live stream, so you can take a look at that. All right, everyone, we made it through Halloween, and we are looking at an election on Tuesday. I think that's going to take a lot of the attention for people's minds for the first, I would say, 3 days of the week: Monday, Tuesday, Wednesday. And hopefully we get through that nice and peacefully. We have a transition of power that is done peacefully. No big, giant problems there. And, we get back to just investing in companies. And it'll be interesting to see the earnings that come out next week. So that is the stream for this evening. I appreciate you tuning in. Let me wish you a really nice weekend, and I will talk with you soon.